day, everyone. Thank you for joining us once again here at Seafood and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the Fed statement from last week, look at the projections in that infamous dot plot, and then look over some other economic releases that had come out. So overall, last week when the Fed met and then they put out their release, it wasn't too much of a surprise what they had to say. They continue to say that the labor market continues to strengthen and that the economic activity has been rising at a strong rate. And we've seen that with the GDP release for the second quarter above that 4% at that 4.2%. And then also with that Atlanta Fed GDP number, that GDP now, that continuing to show an excess of 4% growth rate for the third quarter projection. So we continue to see these stronger numbers come out. But overall, job gains continue to be strong. And then we have the household spending and business fixed investment have been strong as well. And we continue to see that as the underpin of everything is this continual increase in the overall retail sales and the business investments. And that's what we were hoping to happen at the end of last year with the tax cuts, that those tax cuts would spur on that additional business investments. And in fact, we see a glimmer of hope, of fact, that that's coming to fruition. But overall, the indicators of long-term inflation, however, are little change and they're on balance. So continue to see no real big push-up in the overall level of inflation, and therefore the economic outlook appears to be roughly balanced, and they continue to put out the gradual increases in that target range. So because inflation is not spiking up, we don't see the need to increase those Fed fund rates, the ranges, faster than at 25 basis points. And they're going to continue to gradually increase that by that 25 basis point increment as we move along. And we'll see that in their projections. But overall, we see that it's the economic activity is roughly balanced. And as we know, they raised rates. Looking at the overall projections, you can see over the course of time, 2018, they bumped up their GDP expectation to 3.1 from where we had it back in June at 2.8. So we had a little bit of an increase there. And then we had 2019 come up from 2.4 to 2.5. So continue to show that stronger economic output in 2019. But then 2020 and 2021 begin to pull off a little bit, ending at that long run number of 1.8. So to me, that's kind of worrisome because we continue to see that the strength of the economy that we're seeing now kind of starts to wane a little bit as we move out further into the projection period. Overall unemployment rate continue to be strong, and then in 2021, we come back up to where we are, 3.7%. No real big change in that inflation number, be it the all-in PCE or that core number continues to be right around that 2% rate where that Fed wants it to be. So overall, when we look at the dot plot, we can see the changes, not too much of a change. The December kind of locked in for that rate change. Then we have about 3 for next year in 2019, according to the dot plot, 1 more in 2020 for that dot plot, and then almost staggered or stagnant after that at that 3.25 to 3.5% range. A little higher than what their long run is. So it's kind of interesting where that could suggest that maybe after 2021, they're going to start pulling back a little bit, maybe reduce down that Fed funds rate back to their longer run. But to me, this is pretty aggressive. With the growth rates that we see in the inflation, I don't see why we would need to get up to that 325 to 350 mark out in 2020. But when we look at the market and the implied probabilities, we can see the November one, no real change. December looks like there's a 71.6% probability as of this morning of a rate hike there. And then after that, we have to go out to March for the next rate hike. And it's pretty balanced. We have a 40% probability of it not changing after the December rate hike, and then a 48% probability that it will be increased. So that's roughly balanced. And throughout next year, all 2019, seems like the market's just saying one more rate hike in 2019. So pulling off a little bit from where the Fed has their dot plot. So it'll be interesting as we move throughout 2019 to see how these numbers kind of shake out. But looking at some economic trends, we had from the Census Bureau, wholesale inventories up 0.8. That was a positive, and that positive to that GDP Now number, stronger than anticipated. So we see those inventories flow back in, and when we see the retail inventories up 0.7%. So both on the wholesale side and the retail side, see a bigger inventory replenishment, which is what you would expect with the amount of inventories that have been depleted throughout the past couple of quarters. The advanced international trade, this is just a goods deficit, not the goods and services, but the goods deficit. We continue to see increase in here, up by 5.3%. And then we look at the overall construction, and we see construction spending up just 0.1% on overall. Residential, however, fell by 0.7%. So we had a pretty steep fall off in the residential, and then non-residential's up by an equivalent 0.7% here. So the stronger area is that non-residential. And if you look down through the different categories in here, you'll find that a lot of this has to do with some public projects, roads, construction, some manufacturing. Actually, manufacturing came down a little bit, but sewage and waste disposal, highways and streets, they continue to be fairly strong in their year-over-year numbers. But overall, when we look at the year-over-year, up 6.5%. So it's fairly strong on that construction. That continues to help build those construction jobs. Well, that's what we have for you this week. We look forward to talking to you next time when we review over some economic numbers. Have a great week, everyone.